It's Friday, December 5th, 2025. Here's what's happening and what it means for your money. Cash sitting in a bank account is losing purchasing power. Over the last 3 years, that's roughly 25 cents on every dollar. Same paycheck, same savings, but groceries, gas, rent, all cost more. The dollar is shrinking. The protective move is owning things that rise when the dollar falls. Gold, silver, commodities, companies that pull real resources out of the ground. Here's the data behind that. The bond market is flashing recession. Short-term government bonds are now paying 3.55% while long-term bonds pay over 4%. Usually short-term pays less because you're not locking your money up as long. When that flips, investors are bracing for trouble. Private payrolls dropped by 32,000, confirming the slowdown. Yet gold is at $4,273 and silver has broken 59. The economy is slowing while hard assets, physical things like gold and silver that can't be printed out of thin air, are screaming higher. The Fed is being forced to cut rates to keep the economy from seizing up. But their emergency liquidity buffer is empty, so when they inject new money, it flows straight into the system. Rocket fuel for hard assets. Short term, expect chop. Medium term, the Fed restarts the money printer. Long term, over 12 to 24 months, the government debases the currency to keep up with its own debt payments. This thesis fails if the 10-year yield drops below 3.5% without Fed balance sheet expansion, or if the December 16th inflation print shows genuine deflation. This analysis started with a question: what's actually driving markets underneath all the noise? The process is digging into Federal Reserve data, credit markets, liquidity flows, learning what the terms even mean along the way, and testing whether any of it holds together. If you have questions, thoughts, or data that challenges this, please share. That's how we figure it out. Data sourced from the St. Louis Fed database and Chicago Board Options Exchange yield charts.